Now.
Good morning, everyone, and welcome to the Investing Conference. This is day 3. This event is brought to you by TimingResearch and TradeOutLoud. The event is being recorded, and all the recordings will be available as soon as they're processed on the TimingResearch.com website. David Kosmeter and I, Uncommented Cap, will be your host today. So before we begin, let us remind you that all information provided today is for educational purpose only and should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, cryptos, or any instrument of any kind. Trading involves a high level of risk and may not be suitable for all traders or investors because you could lose money. Before deciding to trade, you should carefully consider your objectives, your level of experience, and definitely your risk appetite and your risk tolerance. Individual performance depends upon each person's skills, time commitment, and effort. Results may not be typical, and individual results will vary. You must do your own research and make your own trading decisions. And with us today, we have again another fantastic lineup of pro traders and investors that are ready to share fantastic strategies with you that work for them, as well as tips and tricks. And we have Alaina that is going to kickstart our event today. So welcome back. We're really happy to have you back here. And I love the title of your presentation.
Thank you so much. I'm excited. So today I'm definitely going to do like a deep dive into the S&P 500. And we're going to talk some more about long-term investing, things like that. And I just want to give like a general overview of the market, and then we're really going to like zero in on the S&P. Let's see. And just to introduce myself, I'm Alaina. I'm a co-founder of Options Bay and Investing Bay. And we really just take people in of all experience levels. We get into stocks, we get into real estate, cryptocurrency, all types of things. But the S&P 500 is my absolute favorite thing to trade and invest in. So I'm excited about this. All right, so I did have a risk disclosure, but you guys just heard that. So just remember, it's all educational. One big thing to remember too is anytime we're talking about long-term investing, you really don't want to put any money in the market that you're going to need immediately. So like money for bills, money for tuition, vacation, things like that. You want to put money in the market that you can stand to, hold off on for at least the next 5 years. So we're talking super long-term. So one of the first things you want to take into consideration when you are starting to think about investing long-term is your approach. Some people like to do individual stocks, others like to be a little less active. Think about your personality and like really what type of investing would fit into your lifestyle and your personality. So are you someone who's analytical? Do you like crunching numbers? Do you have a lot of time to really dedicate to your investing? Are you someone who's super busy and you don't really have time to analyze stocks, like individual companies? But regardless of those statements, investing in the market is absolutely for everyone. So let's get into it. You definitely want to first decide how much you want to allocate towards your investing, how much you want to invest. Again, you don't want to put any money in your long terms that you're gonna need like in the next 5 years at least. The market is most certainly gonna rise over the long term, but there's a lot of uncertainty in the short term. So that's where options and things like that kind of come in, because you can take advantage of those short-term fluctuations in the market. A drop of 20% is that can happen, right? It's kind of happening now, but it's not unusual, right? So historically, our bull market lasts longer than our bear market, but again, we do have dips and things that we have to consider. Next, you want to think about your asset allocation. What do you want to do with the money you're going to invest? So you want to take into account some factors like your age, your risk tolerance, your personal goals. One thing I always tell my students is like, make sure when you're investing, it's like your portfolio is literally personal to you, right? So it doesn't really matter what the next person has going on. All of your decisions that you make in the market, they have to make sense for you in your life, your account size, your risk tolerance. You never want to compare. You really never want to try to compete with anyone. It's not a contest. So just keep that in mind. But the general idea is that as you get older, stocks become like a less desirable place to keep your money. If you're young, You have a long time ahead of you to really ride out, fluctuations in the market. But this isn't necessarily the case if you're retired and you're relying on that income. I would add this because I think she's 80 now. So we do have a lady in our community. She's 80 years old and she scalps the SPY and she scalps the QQQs and she's adorable. And so I'm not saying, as you get older, you can't still be aggressive. But again, you always want to have that nest egg. You always want to have that retirement ready for you when you're ready for it. So one of the first things you're going to do is open up an account, a brokerage. And there's a couple different ways you can go about this. So you have your standard brokerage. A standard brokerage, that's basically like, a lot of people start on Robinhood. I would say when we're talking about long-term and really accumulating a lot of capital, you probably don't want to do that on Robinhood for tax reasons. But those are like your standard brokerages. You can go in, you can make a trade, you can invest money and really pull it out whenever you want. For short term, you're going to look at, you're in that upper capital gains bracket. So you're going to pay the most if you're buying and selling within the first year. But you also have individual retirement accounts, your IRAs. So this is really cool for long term because they're tax shelters. You can actually invest in these. You can contribute, I believe it's $6,000 a year. But you can build up those stocks in those portfolios. That way, when you're ready to pull from that IRA at retirement age, then you actually aren't going to be taxed on that. So that's a really cool thing to do once you start building up capital. You also have 401ks. But the real thing you want to think about when you're deciding what kind of account you want, and I definitely think it's a good idea to have like multiple, but how easily do you want to be able to access your money? For me personally, when I started trading full time, that was my main source of income. So obviously I wasn't going to do early withdrawals out of an IRA because I was penalized for that. So really early on, all I had was a standard brokerage because I was still using that money to pay the bills. So just keep that in mind. But again, as you build up your capital, you definitely want to start thinking about taxes and the IRS and ways that you can benefit yourself as a trader and investor. So this is a quote that I love from Warren Buffett. It's, you don't have to do extraordinary things to get extraordinary results. And so one of the cool things about investing long-term is literally all you're doing is finding the strong companies. You're looking for companies with like a strong, competitive advantage, who's going to outlast. And it's really just buying and holding, like that's all you're doing. And so when we really get into, and I think it's in the next slide actually, but like Warren Buffett said, you're not doing anything spectacular. You're literally just buying and holding. This is just some brokerages I threw up here, just some examples. Again, Robinhood, not the best place for your retirement, but you have like Thinkorswim, Webull, E-Trade, Fidelity, Charles Schwab. All these guys offer those retirement accounts along with those individual accounts. So as you do start to develop that long-term portfolio, those are going to benefit you way more than a Robinhood would. All right, so let's get into more specific on the SPY. So in the market, we have three major indexes. You have the S&P 500, you have the NASDAQ Composite, and you have the Dow Jones. So the S&P is going to be 500 of the top companies in the US. I believe it's actually 505 companies, but this includes Apple, Microsoft, Tesla, Amazon, Facebook. The list is long. You also have the NASDAQ. Those are going to be heavily tech weighted stocks. And the Dow, those are like your blue chips. So those are like the most, oldest, most influential companies in the market. And so the S&P is really like the benchmark for the economy. A lot of investors and analysts use the S&P as a benchmark to how the actual economy is performing, because the strongest, top companies are there. So when we talk about long-term investing and we talk about, the bull market lasting longer than the bear market, if you look at a chart on the S&P right now, in the last couple of months, we've had this pullback. But if you really zoom out on the chart and look at like 1 year or 5 years, it's like an on-ramp, right? The S&P just rips and it just goes up, right? So these pullbacks, They're totally healthy. They're totally normal. We do have a lot of stuff going on in the economy right now. But this isn't the first time a lot of these things have happened, right? We've dealt with inflation before. We've dealt with like global conflicts and things like that before. We've dealt with quantitative tightening before. So none of this stuff is like super new. Now, if we talk about COVID, things like that, that's, you know, a little different, but nonetheless, the overall trend, right? The primary trend of the S&P 500 is actually to the upside, as with the NASDAQ and the Dow. So you can also break the market down into sectors. When we talk about like building out a balanced portfolio, you can actually break your the market down into these sectors. And so what you want to do is you want to kind of pull from each sector because there's something called a sector rotation. So depending on where we're at in the economic cycle, there's also something called seasonality. You'll see money move from sector to sector throughout the year, throughout the economic cycle. For example, if we look at like consumer staples, right? Those are things people buy because they need them. So that's like your Procter and Gamble, right? Like your food and your water, things that people have to have no matter how much money they have. So when we have periods where the economy is contracting, like, you know, recession, we hear that every day now, but you'll see money move into those consumer staples. You'll also see it move into energy. And so other things like when we're in an expansion phase, right, when the economy is growing, then you'll start to see money move into your consumer discretionary. Those are the things that we buy that we want. So it might be like our new MacBook, or we might be building a new deck on our house, like things that we actually, you know, have extra money to spend on. That's where you see that rotation kind of happen there. And so having a balanced portfolio actually allows your portfolio to actually survive these things. Like imagine being heavy in one sector and then that sector getting beaten down, right? Your portfolio is going to be a little lopsided. So we definitely want to pull from every sector, find the strongest companies there, and then we can have a balanced portfolio. That's just a risk management strategy. The cool thing about investing in the S&P 500 is that all of the sectors are represented within that index. So you can actually invest in literally the overall market, and you're just betting that the market is going to rise over time. And that's a pretty safe bet. Again, there's different ways to diversify different types of securities. You have individual companies, you have index funds, stock options, you have dividend stocks, commodities. So you have like oil, corn, lean hog, you know, there's just, the list goes on and on. You also have real estate and crypto. So exchange traded funds, ETFs are essentially, I think of it as a basket. But basically what these funds do, they go in and invest in stocks and securities of a specific industry or sector. For today, the ETF that we're really going to dig into is SPY. You'll see people talk about SPY all the time. It's really widely traded, but it's an ETF that tracks the S&P 500. So if the S&P 500 goes up, the SPY goes up with it. If the S&P is going down, the SPY comes down. And so it's pretty cool to be able to trade just the overall market. Those options, they're super liquid, they're low cost. It's a little volatile, but nonetheless, it is, well, I don't want to say a little volatile, it's very volatile, but nonetheless, over time, this thing can run, right? So it's really cool just to be able to invest in just the overall stock market. I think that makes our jobs a lot easier as investors. All right, so the SPY, again, it's an ETF tracking the S&P 500. It's listed on the New York Stock Exchange. It stands for Standard & Poor's Depositary Receipts. Basically, the one share of the SPY is 1/10 of the S&P 500's level. There are some other things, other tickers that follow the S&P 500, like you have SPX, you have like Vanguard, like VU, things like that. But again, SPY is like my personal favorite out of all of them. This needs to be updated. The year-to-date return, I believe it's -16 is what I saw this morning, but we're open now, so I'll check it for you guys updated. So right now, our year-to-date return on SPY is actually negative 17.34. So that's okay. We are having a rough year, but nonetheless, the biggest gain on record, 38% in 1958, which is insane. The biggest drop on record, 2008, 38%, 38.49%. Again, the SPY, it is the largest index that tracks the performance of those 500 large cap stocks. It holds, let's see, 42 trillion market cap. I believe that needs to be adjusted as well. We've come down since this was last updated, and I'm sorry for that, y'all. But it is more than 75% of the total US stock market, comprising 11 different sectors. Like, this thing is massive. Even on SPY's like low volume days, the trading volume is crazy, you know, compared to the rest of the market. Like, the volume is there. It's just really, really heavily traded. But the companies are actually voted in and out of the S&P by a committee based on factors like market cap, revenue, liquidity, the sector, the performance, the trade value. And so a cool thing with this, an example that we can go through is like Tesla. So Tesla was last year, I believe, was inducted into the S&P 500. And a lot of analysts were kind of wary of that. They were kind of worried about that because Tesla is really volatile. So they didn't know how Tesla coming into the S&P would move, because each stock in the sector, each stock in the index is weighted. So, you know, if Tesla has a great day, then, you know, it could pull the S&P up. If it's having a bad day, it could drag it down. So people were worried that that was going to make, you know, the S&P a little more volatile. But nonetheless, this thing, it's literally used as a benchmark all the time to measure how the economy is performing. And you'll see, like, as companies get voted in and out, it actually will affect the price of the S&P, the SPY. And so, or not the SPY, it'll affect the cost of the share. So like when Tesla announced they were going to go in, the share price went up. You know, companies, they'll say, you know, this person's coming out and we're swapping them for this. And typically the companies that get pulled out, they have a drop in their share price. So that's pretty cool too. So a $10,000 investment in the S&P 500 index in 1965 would be worth 2.6 million as of the end of 2021. Assuming you reinvested all your dividends, this is a return on investment of 26,000% or 10% a year, which is not bad at all. Really, when I look at things like this, like the market we're in now, this has come way down from the high. And so like, these are good opportunities to kind of buy in, which I do think we should see more downside moving forward, just with quantitative tightening and things. But nonetheless, you know, the elevator will eventually come back up, and this is just in a really good spot right now. So another one, a $10,000 investment in the S&P in 2011 would be worth $43,961 as of the end of 2021. And again, that's assuming you reinvested all your dividends. That's a return of 339.61% or 14% a year, which again is insane. And that's literally just buying and holding. So how the S&P works, it works on a weighted market cap method, which means that companies with a high market cap have a high ranking in the index. And so if we think about, like, you know, a high market cap gives them a higher ranking in the index, then like the first company that comes to mind, which they're actually the number one in there, is Apple, right? Apple has, you know, huge market cap. And just how you calculate that, again, it's just the company, how the weight is calculated is going to be the company's market cap divided by the total market cap of the index. And so I put the formula in here, but this isn't any math that you would ever have to do in your life unless you just like to crunch numbers. But you can typically Google this, right? You can just Google the S&P and the weights, because they do kind of fluctuate a bit. But yeah, you don't ever have to crunch the numbers unless you just want to, because they will get crazy with all the big market caps. And so, oh, here's the example. So Apple had a market cap of 2.998 trillion as of January 4th. While the total market cap of the S&P is 42.368 trillion. estimated to the weighting of Apple stock was 7.06 in the index. And that, of course, has been adjusted since we've our prices fluctuated. Okay, so let's get to the next one. All right, so this slide, I had a time trying to make this, but nonetheless, this is all of the companies in the S&P. So there's actually 505 companies. Some of these have like multiple classes, right? So they might have like A class and C class, or A class and I believe A and C for Google. But nonetheless, they're in order. So here's your top 10. One thing you'll notice is that, and even on my watch list, like I trade the SPY and the SPX every day. Like that's like my bread and butter. I love to trade the S&P. But on my watch list, I literally have the top 10 stocks in the S&P, the top 10 heaviest weighted stocks in the S&P. And what that does, and again, the weight on the top 10 is more than 30% of the index. So if one of these tickers is having a great day, really, namely Apple and Microsoft, but these guys can really pull the index around because they carry a lot of weight. Another thing that's important to take note of is a lot of these top 10 are actually in tech, right? A lot of these are actually listed in the NASDAQ as well. And we actually saw this yesterday, but a lot of times you'll see the S&P and the NASDAQ kind of trend together, and the Dow kind of does its own thing. And a lot of the reason of that is these tech stocks, right? So tech has a lot of say in the direction of our market. If y'all remember, I want to say it was Monday, maybe Friday. I think it was Monday or Friday. Apple came out and said they were going to slow down hiring, and the market was literally trending up all day. And then as soon as Apple came out with that news, the entire market came down, like all of it. So Apple literally drug it down. I actually heard someone say before, like, we're in trouble if they start selling Apple off. So Apple and Microsoft can really, really help you dictate the direction of the S&P because they're just so heavily weighted in there. And there again is our top 10 holdings. Again, these weights, I believe, are a little off now just because our share prices have changed, our market cap has changed, but nonetheless, that was the last order. And so the S&P index represents the top 500 large cap stocks based on the weighted market cap. And so in contrast, you also have like the Dow, right? So the Dow is a little different. They're price weighted. So the Dow is price weighted. And then the NASDAQ, it works on an updated market cap method. So they're all weighted in the different indices, but the criteria and the way they're weighted is different. So that's important to note. But just for the purposes of S&P, just know that it's really focused on their market cap. So these are just some major milestones in the S&P that were super important. And I like to point these out because, like, especially when people come into the market and they're maybe newer to investing, they might look at those red days and be horrified. But just keep in mind as you navigate the market and really like start your journey or continue your journey, really train your mind to see as an investor, like really think like an investor. So the red days, those are opportunities, right? They're not like the sky is falling, like they're really opportunities. Like we've had crashes before, we've had black swan events, which a black swan event is like something random that happens like COVID that no one really saw coming. And it affects the market. And so just keep in mind, we bounce back from those things. Historically, we've bounced back from all of these insane things that have happened. But nonetheless, just all these big drops, we've come back from them. So just don't freak out when you see red. Again, just take full advantage of the red. So a lot of people also don't know that S&P 500 has a dividend. It actually does pay out a dividend. So just buying the SPY and holding on to that ETF, you can actually get paid in passive income for that. This is just a little quick chart of the dividend yield, and it does fluctuate. You'll notice, one thing I noticed was like it kind of moves with inflation, right? So it kind of ticks up when the inflation goes up and then it kind of cools off. But nonetheless, let's see, the dividend is calculated by taking the weighted average of S&P companies, their annual dividend, and dividing it by the current share price. This is updated quarterly. So we get a new dividend yield like literally every quarter. It shows how much money an investor who invests in the index might expect to gain from dividend payouts alone. Let's see. And then this down at the bottom. So all annual dividend yields are quoted exclusive of inflation. The effects of inflation reduce the real impact of all returns, including dividends, and can make it more difficult to grow wealth, which I probably sound like a broken record, but we know inflation, it makes our money worth a little less. It makes the price of everything else go up. So just remember that like inflation definitely has an impact on the dividend over here. All right, so here's our returns. And again, if you guys remember earlier in the presentation, I was talking about how the red, it's okay, right? It's okay. We just breathe and we trade through it and we just add on to our long terms with our profit. That's all we're doing. So this isn't the worst year we've ever had, right? According to a 2020 report, over a 15-year period, nearly 90% of actively managed index fund or investment funds, failed to beat the index funds or market. It's a safe and diversified investment that has historically kept it secure from too much market fluctuation and provides great returns in the long run. The S&P has generated around 10 to 11% average returns and 7% inflation adjusted returns based on historical data. So things that can affect your S&P returns are inflation, capital gains, and timing. I will never forget I think it was like in December or January, I had someone come to me and he was like, hey, I'm going to buy these $500 SPY calls. And I was like, that might not be the best idea. I can't tell you what to do, but, inflation was ticking up. Russia, Ukraine was kind of heating up. The market was in this like distribution phase where we were just totally moving sideways and really struggling to push higher. And so I was just telling him, I think we might, cool off a little bit here in the next couple months, but he was dead set on his idea, didn't want to hear any logic. And I don't know, I actually heard from him since, but I don't think it went well. I don't think it went well. So just make sure when you are investing long-term, timing is everything. And you can never time the market, right? You can't time the market, but you also you don't have to buy the top, right? You don't have to buy the top of the mountain. We want to buy the valleys and then ride up to the peak of the mountain. So what moves the S&P 500? Sentiment, right? How do the investors feel? A lot of things that come into this, like you have economic data, macro is huge. For me personally, I trade again the S&P every single day, and I'm constantly paying attention to what's going on in the news, constantly. So you have your interest rates. We'll find out more about that on Wednesday. Politics, current events, whether it be here or internationally. You have natural disasters, you have supply and demand. And so when you're talking about, literally, we're talking about the S&P, that's the whole market. So there's a lot of things that can affect that on a bigger scale, right? If we're just talking about Apple, then we're really focused on things that affect Apple. But when we're talking about the S&P, we're talking about things that affect everybody. So that's a big umbrella. It's a really big umbrella, but I think it's interesting. I really think it's interesting to just stay current on what's going on. I love to dig into these economic reports. Like I love it. So, all right. So we can't talk about the S&P 500 unless we talk about the VIX. So if you're not familiar, these guys are inverse, right? So the VIX, this is our volatility gauge. It's going to measure the fear in the market. And basically what happens is when the S&P goes up, the VIX comes down. When the VIX comes down, the S&P goes up. And it's literally like an inverse opposite relationship most of the time, right? Most of the time. It's not an always thing. Sometimes you'll find days where they move together. It doesn't usually last very long, but it's never like, I'm never going to say this is a sure thing. It's always going to be opposite because sometimes it'll blow your mind. But VIX was created by Professor Robert E. Whaley in 1993. It is again inverse with the S&P 500. You also have multiple volatility measures. So you have like VIX, you have like VIX, you also have UVXY, UVXY. But again, they're just going to inverse the SPY. It's a fear gauge and uncertainty indicator. A lot of times you'll see the VIX kind of spike. And again, when you see the VIX spike, you should see the S&P kind of come down. But anytime there's like, you'll see VIX spikes around FOMC announcements, those meetings, the minutes. If any type of Fed speaker comes out, really when Biden comes out to speak, a lot of times you'll see that. But anything that scares people, scares investors, you should see a spike in the VIX. And then the VIX typically will come cool off and it'll, the market will recover. But again, it's really cool to keep your eyes on the VIX, because if you notice it kind of creeping up, then hey, the market might be about to drop. Like I think the VIX is actually up now. I think it gapped up last night. Yeah, it did. So yeah, the standard deviation range here is 12 to 30. So we're going to do this, like this is going to be inverse like 65 to 75% of the time. It's never going to be always. It's calculated based on the 30-day option prices of the S&P 500. And it's only traded through futures and ETFs, right? So VIX is the ticker I like to watch, also UVXY. But again, it's one of the most widely used measurements of expected volatility and is the VIX, right? So the official name, it's SIBO Volatility Index. It's a forward-looking indicator of future volatility in the S&P 500. It reflects the sentiment of option market participants. Investors use it to evaluate levels of uncertainty for upcoming price changes. So like the VIX, if you look back, and actually I believe I have a chart for you guys. Oh, it's right here. Okay, so I was like, I'm thinking like myself. Okay, so at the top of this is going to be the S&P 500, right? At the bottom, this is the VIX. And so these like circles, you'll notice here's a dip in the S&P, there's a spike in the VIX. This is COVID, so there's a dip in, well, this is bigger than a dip, I would say. This would be like the crash. So here's the crash out in from COVID-19, and then here's this crazy VIX spike. I believe VIX went up to like, it was in the 70s if I'm not mistaken. But nonetheless, I just wanted to illustrate that inverse relationship for you guys. And so what you'll notice is the higher the VIX, the more, the more scared people really are, like the more fear and uncertainty there is about the future. When the VIX is low, that's just like basically everybody's like breathing, like, okay, we can calm down now, everybody, the buyers come back in. But yeah, it's just a really cool way to just keep your eyes on, how people are feeling. It's a really cool way to do that. Another thing you can do is the fear and greed index. And I'll show you guys that too. Let's see. Okay, so the fear and greed index, I'm just going to pop out of my presentation and I'll show it to y'all so you can see it. I think I'm frozen. All right, so just when we're talking about fear, this will give you like, I believe there's 7 different things. Yeah, 7 different indicators that'll tell you really how investors are feeling. So when we go into extreme fear or really fear and all the way down, people are afraid and you should see the market kind of come down. And this gets updated pretty regularly. But there's just all these indicators that you can read up on and they'll just really tell you about your sentiment in the market. And so this is something that I really like to keep up with too, just to see how people are feeling. But let's get back. I have so many tabs. Sorry, I just kind of went off script, but I really wanted you guys to see that. So we'll get back into this. All right, so here is, okay. So the standard deviation, which again, I remember in high school, I was like, I'll never use this. And then here it is. So the standard deviation is a cool metric. It describes the spread of volatility. As it indicates, the VIX has a moderate standard deviation, which means it trades in a very stable manner. Data shows 95% of the time, VIX is going to be between 10 and 44. 65 to 75% of the time, it's going to be between 12 and 30. So anytime you see the VIX kind of outside of this, those are really like outliers. So what, like when it's super, super low, that's not normal. I mean, it's not, I'm not going to say it's abnormal, but it's just not the norm. It's really not the norm. It's super, super low. Anytime we're above, 44, that's pretty high. But here's another example. These are some VIX levels to watch. And we're kind of in this range. We're in a weird range right now. Like I was actually speaking about this the other day, how the VIX is really having a hard time even getting to 30. We're still well below 30. But with everything going on in the market, it's kind of like a lot of it, I feel like, I don't want to say it's priced in. We just have a lot going on, but it's like the market just, people are buying up things, but nonetheless, up here is kind of where you freak out a little bit when you get in like the red zone. But yeah, we've really just been kind of hanging out right now between 20 and 30. Anytime we get above 30, I feel like it just gets crushed right back down. So I'm curious to see what happens with the VIX. But historically, you'll see a lot of people online like calling the bottom of the market, but historically, I don't think we've bottomed before with the VIX below 30 like this. So I'm not sure. We'll see. We will definitely see. So here's another example dealing with the VIX. Jay's my business partner, so I used him as an example. But Jay, who is a tall investor, had figured out in early 2020 how the coronavirus was going to affect the stock market. In such a situation, he bought VIX futures and ETFs to secure his portfolio. As you can see in the picture, Jay saved himself from the coming market crash by hedging his portfolio. So essentially, let's say we have a ton of shares in the S&P, and really you can hedge with anything, but just for this example, if you see that a huge, if something on the horizon, which nobody really saw COVID coming, but you can absolutely play the opposite direction. So if you're heavy in S&P and we're having a red day like we are now, I believe, you can jump in VIX and you can hedge. You can hedge anything, right? So let's say we have Apple or Tesla, those are having a bad day, we can hedge our shares. So that's all I wanted to show you guys here. I just will never forget when I started investing, someone was like, you shouldn't quit your job for the stock market because the market's going to crash. And what are you going to do? And I'm like, there's so many ways to make money on a crash. So many ways. So don't ever forget to play the inverse if you want to. And you can also play the downside. You can also run your puts and play the downside. You can sell calls. If it's red, it does not matter. It does not matter. So we actually made a little quiz. I don't know if you guys want to take the quiz, but we did make a quiz for our students just on the class. I don't know. That was actually my last slide, unless you guys want to get into the quiz. Yeah, good job, Jay. The highest weighted stock in the SPY. Do y'all remember what that is? It's Apple. And that's important. If you're going to trade the S&P, whether you're doing short term or long term, you definitely want to know which one's the heaviest, which all three of them are important, but Apple and Microsoft, you absolutely want to know what those guys are doing. Okay, we didn't get into candlestick patterns. Cup and handle, that's a continuation pattern. Okay, I don't think any more of this is from this class, guys, but yeah. Does anyone have questions about the S&P or the VIX or anything? Let's see. I know that was a lot of information, but I don't know. The SPY is pretty cool, especially if you're just building up that account. Like, it's super low cost. Definitely want to be good with your technicals and your charting before you jump into it, because it does move pretty quick. But it's a cool way to build capital really fast in your account. It really is, just because it's really not expensive at all to trade short term. But just we always like to think long term. So when I say trade short term, I'm still referring to like profit from short term rolling over into long term. It's always a long game. But if anyone wants to come hang out with us, we do have a free community on Slack. And we're on like all your social media, things like that, at Options Bay and Investing Bay. But yeah, that's all I have, David. I'll drop the Slack link down in the chat if anyone wants to pop in. But that is my last slide.